The true goal of long-term investing is not to buy a Lamborghini at 65. It is to build enough concentrated capital to achieve financial independence, take absolute ownership of your life, and buy back your time years before traditional retirement. But if you are managing your money based on traditional retail advice, you are being fed 3 dangerous misconceptions that guarantee you will stay tied to a soul-crushing job out of necessity. When a severe drawdown hits, these myths cause amateur investors to panic. They get burned, sell at the absolute bottom, and flee the market forever, mistaking their emotional capitulation for risk management. Today, we are dismantling the 3 lies that are sabotaging your wealth. We are replacing retail myths with structural truths. System over emotion. The first myth is the illusion of safety. Retail investors are consistently told that long-term savings should not be fully exposed to the stock market because it is too risky. You are pushed into so-called solid assets, cash, low-yield bonds, and certificates of deposit, under the guise of capital preservation. The structural truth is that hiding in solid assets guarantees the destruction of your purchasing power via inflation. Avoiding market volatility does not eliminate risk. It simply trades the temporary discomfort of price fluctuations for the permanent, invisible decay of your wealth. Let's look at the cold math. Assume you deploy $100,000 into a safe asset class, yielding a 5% average annual return. Over a 25-year time horizon, that capital will compound to approximately $338,000. Now, contrast that with optimized market exposure, yielding a 15% average annual return. That same $100,000, compounded over 25 years, grows to over $3.29 million. The difference is staggering. By prioritizing emotional comfort over structural growth, the safe investor pays an opportunity cost of nearly $3 million. Volatility is not a flaw in the system. It is the exact mechanism that pays you the premium required to buy back your time. The second myth is the rebalancing penalty. Traditional financial advice dictates that if a winning position grows too large relative to the rest of your portfolio, you must trim or sell it to rebalance your allocation. This is a severe architectural error. Risk is strictly tied to your initial capital investment, not the current, inflated market value of the position. To grasp this, you must understand the math of asymmetry. When you buy an asset, your downside is mathematically capped at 1 times. A position can drop by a maximum of 100%. However, the upside is nonlinear and mathematically infinite. An asset can compound by tens of thousands of percent. If you mechanically cut your winners early, simply because they performed exactly as intended, you actively destroy the right tail of your distribution. You are mechanically amputating your compounding engine. Instead, the portfolio architect utilizes a mechanic called the risk-free runner. When a highly successful position reaches a specific target, the system dictates taking a precise, partial profit to extract your original risk capital. You then move your stop loss to break even and step away. Your cost basis on the remaining position is now 0. You allow that zero-cost asset to grow infinitely, absorbing all future upside with absolutely 0 structural risk to your core foundation. The final myth concerns leverage and decay. The prevailing academic consensus states that you cannot hold leveraged ETFs, such as 3x instruments, long-term because volatility decay, or beta slippage, will inevitably wipe out the portfolio. That consensus is mathematically correct, but only if you blindly buy and hold. The architect does not buy and hold leverage. The architect trades it mechanically within a highly specific container. In our framework, this is executed within the volatility harvester segment. This segment exists to accept violent price instability in exchange for explicit compensation. Crucially, this strategy must be executed inside a tax-advantaged retirement account to generate tax-deferred alpha, eliminating the friction that destroys compounding. You do not hold a 3 times leveraged ETF passively. You operate it mechanically. You systematically accumulate the asset into severe, fear-driven drawdowns when the market panics. Conversely, when the market experiences violent upward rips driven by euphoria, you scale out mechanically, locking in profits. By actively managing the exposure against extreme volatility bands, you harness the math to your advantage. You harvest the decay instead of suffering from it, converting market chaos into a precision yield engine. A retirement portfolio has exactly 2 jobs: survive bad markets and exploit good ones. The retail investor fails at both because they are entirely driven by fear and consensus. Wealth is built by those who ignore emotional panic, understand the power of mathematical asymmetry, and relentlessly execute a mechanical system. You do not manage your wealth by predicting the news. You manage it by building a structural firewall that dictates your actions based on logic, isolation, and intent. Stop gambling with your future. Stop confusing inactivity with strategy. Build the machine, enforce the rules, and buy back your time. System over emotion.